Crypto is a growing space with lots of opportunities, but most newcomers in the space end up losing more money than they put in. The reason for this is that they don't have the financial education needed to balance between both wealth creation and wealth preservation. Having an investor's mindset rather than the trader's mindset is essential to make sure that you keep growing your wealth. And the key to this is portfolio management. So in the next few minutes, I'll run you through what a portfolio is and how to set up simple strategies that will get you to both create and preserve wealth in crypto. So, most people get into the crypto space just by chance, right? It's often because a friend of theirs told them about some money that they made in some cryptocurrency, which usually means most newcomers haven't had any formal financial education. Therefore, they tend not to have an idea of risk management or understand their own personal risk tolerances, which can be a real problem as they can make silly mistakes and end up losing all the money that they make along the way. You've probably heard of stories of people who've won $1 million on the lottery and lost it all, right? Well, this story is all too common in crypto too, where people make significant gains but then round trip all their money back down to zero. The reason this usually happens is because, as I've said, wealth creation and wealth preservation are generally two different skill sets. While making money requires taking risks, preserving money requires reducing risks. And it's all about figuring out this balance, this careful balance between both that makes people into good long-term investors. So this week, this video and this post, I just wanted to run through a very basic sort of 101 on portfolio management. These basic frameworks are actually how some of the wealthiest individuals and hedge funds on the planet think about the money they manage. And while this is by no means like a complete course on portfolio management, it'll at least give you more perspective on how to look at your money so that you can avoid making big mistakes and be a savvy participant in the market, right? Now, if you want to set up your first crypto wallet so that you can take part in the growing global crypto economy, plus access over $1,900 worth of courses entirely for free, then click in the link in the description below. So what is a portfolio? A portfolio is just a fancy term for a collection of investments owned by an investor, where the investor can be an individual person or a company or a fund. So if we have an example, let's call this individual Alice, right? She has a $200,000 home along with $25,000 in her bank and maybe another $25,000 in the stock market. This means that Alice's total net worth, the sum of it, is $250,000, and her material wealth can be visualized in this pie chart. We can then take a peek further into Alice's stocks and see that she's put $15,000 into Apple stock, $5,000 into Meta stock, and $5,000 into Nvidia stock. So her stocks pie chart looks like this, right? So you can see that both Alice's overarching assets and her individual individual stocks are themselves portfolios, since they are each collections of investments owned by Alice, right? Most people will aim for some version of this with their own material wealth, whether they're saving up to buy a house or instead of stocks, they've bought a car. A person's overall portfolio will generally be somewhat similar. Now, a quick note is I've purposely simplified Alice's example without including things like a mortgage or a pension, just to get the idea across succinctly, right? Now, when looking at the portfolio above, what we're interested in here is not how Alice views her overall net worth. It's not this, right? It's this slice here. It's the stock market slice. It's her risky part, right? The part that she's willing to risk. The reason for this is that it's not recommended for anyone to have all their net worth tied up in risky assets like the stock market or crypto. So you should realistically only to risk a portion of your total wealth in crypto that you can afford to lose. Now, when allocating money in traditional markets, big hedge funds that manage huge sums of money tend to have somewhat standard formats for their portfolios. And there's one that's incredibly common in particular that we'll look at first. So this more highly traditional portfolio is the 60-40 portfolio, right? It's probably the most traditional investment strategy out there, where investors allocate 60% of their money into stocks and 40% into bonds. There's questions as to if this is still the best method, but it's one of the most standards out there, right? And why is this such a standard strategy? Well, stocks are generally considered to be more high risk, but have historically provided higher returns over time than other asset classes. Meanwhile, bonds are considered to be low risk investments as they are less volatile. Plus, while not all stocks pay dividends, nearly all bonds pay interest and therefore provide a steady stream of income. This mix has historically stricken a good balance between the upside growth in the stock market when things are trending up, and together with the stabilizing effect of bonds when the market trends down, right? You've got both the creation and the preservation. When the market drops, an investor can use the money from their bond allocation to buy up cheaper stocks. And similarly, when the market shoots up, they can sell their overpriced stocks and buy up bonds to protect their profits and generate wealth. This portfolio therefore has a healthy mix of what I mentioned earlier, namely wealth creation, wealth preservation. Now, obviously, this is not how every single investor allocates their portfolio. Some are more risky, while others are more risk averse. Those on the riskier side may, for example, shift towards 80% stocks and 20% bonds, or even 100% stocks, while those on the more risk averse side may shift towards less composition of stocks and higher composition of bonds. There's no right answer here, and we've simplified this conversation massively by not even including real estate and commodities like oil and gold, which are also regular appearances in different portfolio management strategies. Importantly though, this illustrates the basic understanding that successful investors tend to split their money between safer assets that stabilize their portfolio to preserve wealth and riskier assets that are more volatile to grow wealth. Now, let's talk about the 80-20 crypto portfolio. So we've looked so far at how portfolios are generally constructed in traditional markets. Before we even get started, we need to remember that crypto is far more volatile than pretty much any other market out there, right? Which means you can see massive gains, but you can equally experience massive losses, all in a very short amount of time. So the first thing to take into account is that, as I said at the top, you should not put all your eggs in one basket, especially the crypto basket, because it's highly volatile and full of scammers, and all your eggs could break, and we don't want that, right? Now, assuming you've only put the money you're comfortable risking, the next thing to know about this very volatile market is that the rules of the traditional markets don't apply in quite the same way. For example, some meme coins can go from being worth nothing to millions and back to nothing all in a single day. So putting all your money into crazy bets like this is the quickest way to lose it all, right? You get excited, throw all your money in here, it goes up, oh man, I made loads of money, and then it drops down and you've lost it all, right? Don't let that happen. Because of this, a more conservative allocation than 60-40 is probably the best way to approach crypto. Prolific investors like Raoul Pal, I'm not 100% sure how to say his name, suggest an 80-20 portfolio strategy where 80% is in Bitcoin and perhaps some other major coins like Ether and Sol, while 20% is in the rest, right? The beauty of this approach is that ultimately Bitcoin is the most solid asset in crypto, as I've discussed previously in my videos and my posts, and it still grows faster than many altcoins. In 2024, Bitcoin outperformed all but 6 of the top 50 current cryptocurrencies, right? Bitcoin is a very solid play. However, in bull markets, you will often see coins shoot up, 10x or 100x or even more, right? And so having some 20% of your money to allocate on riskier coins is totally reasonable, considering if you get them right, you can completely multiply your overall net worth, right? Yet, even here, it's probably wise to spread out that 20% intelligently. For example, don't just stick 20% on some random meme coin, because as we said before, this could happen, right? For example, if you lose, that 20%, you're down to 8% of your net worth. Meanwhile, if you only say put 50% and it does a 10x, then you've now got 150% of your net worth. But if you lose it all, you still have 95% of it left, right? So even within the risky part, have a conscience of how you're risking it, right? And when you do get home runs, make sure to rebalance your portfolio from time to time so that you have more money on the safe side of the equation, right? where we're saying the safe side here is Bitcoin, which is volatile in itself, but it's less volatile and trends up a lot more than the rest. When it comes to risk, everyone in this market is an individual with different risk tolerances and conviction levels. If you're holding onto a coin and you don't have enough conviction in it, then if it drops 90%, you'll probably sell at a 90% loss. However, if you have strong conviction and truly believe that it's going to do well, you can rebalance using money from the less risky side of your portfolio, and when it comes back, you'll make even bigger gains. This is partly why it's so important to have a more risk-averse assets, right, in your portfolio, because they can give you breathing room to buy up risky assets when the market dips. Yet, even if you have lost faith in one of the assets you're holding, don't be afraid to simply accept the loss. If it's just a meme coin of some passing trend, then it's probably best to cut your losses rather than double down on them and lose even more money, right? Moreover, individuals have different amounts of total of their net worth or accumulated wealth. If you're 18 and all the money in the world you have is just $1,000, then you can afford to be ultra risky and put 100% of your portfolio in the crypto meme coin casino, as you're still young, and if you lose it all, you'll make it back quick enough, right? However, if you're a parent and say you've got $100,000 in the market, you have both more money and more responsibility, so you have a lot more to lose, right? Therefore, you should probably be more risk averse and follow something like an 80-20 portfolio strategy. Imagine having $100,000 and putting 90% on a meme coin that goes to zero. You're now back down to $10,000, and you need to get 10x just to get back to where you started, right? Raoul Pal, has this tweet where he said, since Jan 2023, if you'd held 1/3 of each of the majors, you'd have a 600% gain, right? Which is huge. And he has this quote, "Don't fuck it up, DFTU." There's generally a simple rule in investing, which is that if you're waking up in the middle of the night or in the morning scared about the price of a given investment, then you're taking too much risk. Make sure you've balanced your portfolio in such a way that you can get some sleep. Don't risk your mental health for money. It's not worth it. Finally, this game is rigged in your favor, right? There's no hard and fast rule for how to run your portfolio, and everyone is different risk tolerances, and will do what they think is right for them. However, history has shown that BTC, Bitcoin, will generally trend up, while most coins hit their all-time highs in one crypto cycle and never get past that again. Even ETH and Sol have struggled to hit their all-time highs again, right? Here's a great graph showing most of coins trending down while Bitcoin just keeps trending up, right? Satoshi Nakamoto made an incredible innovation called Bitcoin that just seems to keep going up in value over time. It's the gift that keeps on giving, right? And you can just keep buying more and more of a solid DCA strategy. And I've made a video on DCA strategy before. Sure, there's a lot of fun that can be had in taking bets on smaller coins, but don't don't overdo that, right? The game is rigged in your favor. You just need to survive long enough, and you'll go up as BTC gets wider and wider adoption. We're still in the early innings of crypto. The total market cap is still less than that of Apple's market cap, right? One company is larger than the whole of Bitcoin and crypto. And it'll inevitably grow further and further. Just be patient, be smart, and don't let your short-term desires make you lose the game, right? And as I said earlier on, if you want to set up your first crypto wallet so that you can take part in the growing global crypto economy, plus access over $1,900 worth of courses entirely for free, then click in the link in the description below. And I'll see you there.